Today we'll be dissecting the huge market bounce from the lows to help us determine whether this is just the beginning stages of a new and substantial up leg or only a bear market rally that's destined to fail. At the end of the video, we're going to go over one specific chart to help us gauge appetite for risk going forward, and you may be surprised by this one. So needless to say, the market has now rallied to a very identifiable area of resistance, right? Sliced through the 200-day moving average on the way down, bounced around a little bit between 5,500 and 5,700, and then the bottom fell out. So we had the slingshot higher, which got us to right around the area where you would think there'd be a pause. And of course, it's happening right in front of the latest FOMC meeting. Regardless, here we are. This area comprises the summer high from 2024, then the initial rally in August, the pullback, then where it rallied through again, so the breakout zone in September, which we saw was retested a few weeks later, and then once more right before the election of 2024. And so on the way back down, again, the 200-day moving average is there as well, and this congestion point where that bear flag formed, and bang, here we are. And so if you were to pick a spot where we at least see a pause, potentially some profit taking, it will be right here. And don't forget, this is coming after a 9-day winning streak for the S&P 500, longer for some others. In addition to this, of course, if you put the Fibonacci retracement lines on there, this also is near the 61.8 retracement zone as well. So of course, we call this a collection of resistance points or a confluence, and the more you have together or in clusters like this, the more significant it is. And so we would suggest then that it is a higher probability of a spot to see profit taking, or shorts that worked on the way down to initiate those after covering potentially at lower prices. So let's take a closer look at the 200-day moving average to see exactly how important it is. Of course, the line is known by many people now, and if you have a trading system, if you're even slightly interested in the market and actively trading it, number one, what the 200-day moving average is, what it represents, and more importantly, where it is on the chart, especially when we come close to it. So on the way down is an important one, as when the market attempted to rally in March and failed, it did so right at that line. So at the time, we and many others went back to see the last time that it tested it was back at the end of the corrective period from August to October 2023, and we saw a pretty aggressive undercut and then a quick slingshot higher. So we couldn't really compare the two because 11% over 3 months was a lot different than what happened just in a few weeks, even before the second, even more aggressive down leg happened in April. And so looking back at 2022, so we have the luxury, of course, having occurred relatively recently, and the same type of thing happened. But we had a lot of head fakes along the way. Let's not forget that, because we sliced through the 200-day moving average for the first time in a while, but the initial rally slingshot right back up. So it didn't really seem too detrimental to the overall trend back then. Remember, we're coming off that 2020 low and a very substantial 2021 extension. So when that did fail, of course, then we had the second leg lower. The next rally was even stronger. Of course, that failed, and then failing numerous times along the way until eventually and finally getting back above it as the first quarter of 2023 ended and the second quarter began. And as we've talked about many times, that's when the market character truly changed. Yes, we were off the low at that point, but still had to endure an 8% pullback in December, a 9% pullback from early February to mid-March, which was accentuated by the regional bank crisis. And so after that came through, finally, we got that. And of course, that's when we started to see bullish patterns form and the number of 1% gains and losses or two-way volatility start to subside. The uptrend continued. So that just means that even though we're getting close to that 200-day moving average again and potentially get through it, it's not the end of the story. It could be, this could be an epic V bottom with new highs to follow, but we just have to realize that in the course of markets that endure volatility, they're sometimes not over quickly, whether it's regardless to the 200-day moving average or not. But luckily, this has been a very good indicator in terms of identifying the long-term uptrend, but also as a necessary line to get through to potentially regain the type of long-lasting bid that we've saw over the last 2 years. And we could look at this on a weekly basis as well. These are the 3 weekly moving averages we comment on a lot, with the 40-week moving average in red, basically lining up with the 200-day moving average. And no surprises, that is also testing that. Both of them flattened out a bit. And the other ones are the 13-week, which of course represents 1 quarter of action, and also the 26-week, which is 2 quarters or half a year. And so now back above the 13-week barely after last week. And again, going back to the beginning of 2022, same type of thing. When that 13-week with the faster of the 3 undercut the other 2, it just showed that the trend had changed. And remember, this doesn't occur right away. We have to have a good amount of the deterioration over a number of weeks after a substantial preceding uptrend for this to actually transpire. And when that did, and when we started seeing failures, all those lines, all of them completely rolled over. And of course, we were then had to endure a number of months of just, some pretty excruciating downturns before things finally turned as well. And so one key difference now is that the move was extremely strong in a much shorter amount of time. Remember, before we were down 20% at the beginning stages of the summer in 2022, and then much more toward the lows, but it took a little while and a lot of back and forth movement along the way to get down there before we finally saw the turn. This one, much more severe. As we know, it was the quickest 20% move on an intraday basis since COVID, and that was corrected very, very quickly. There are obvious differences compared to that time as well, but in terms of the price action itself, I would say 2020 is more similar to 2025 now versus what 2022 was. And so if we look down to momentum, or tracking this on the 14-week RSI, the next step, of course, would be for that indicator to get back above that midpoint line and then start to oscillate between the midpoint and overbought territory. And needless to say, that will occur most of the time from early 2023, just through a few months ago. Now, we did have that diverging momentum or diverging RSI indicator with seeing lower highs as the market continued to move higher. And we talked about that at the time, just noting it, not saying that was going to be the death knell of the market. And of course, relying on that alone would have been the wrong thing to do, considering how much further we had to go with the market. At the same time now, we have to get back above that level. And we know that within 2022, at least, it did prove very helpful in the fact that we didn't get too bullish on the market potentially turning. One of the reasons was because the RSI could not get above that midpoint. So that's going to be an important one to watch, of course, again, over the next few weeks to a few months. And then we're also just tracking this former upward sloping weekly channel that the S&P had oscillated within, kind of ebbed and flowed very well within it all along the way, where, wasn't surprised to see selling come near every time it tested the highs, or at least slow down the rate of ascent. And then when it came down to the lower point of that channel, that's where demand came back with much more aggression. And if you recall, in 2024, and as we can see here, the uptrend was so consistent that very rarely did the S&P even get below the midpoint of this channel. So when that happened, and then of course slicing through it through March and April at its worst, then we could just tell that the market character completely had changed at that point. And at the very least, we'd have to see a complete regrouping of things. And so now that has started to occur. Now, we're not going to suggest that if we get back into this range that we're, again, right back into this consistent uptrend. That could look like that occurred, but we know when we have a volatility event like this, even if we get a V bottom, the new potential uptrend would be a new uptrend or a new up leg compared to what we just saw. But at the same time, seeing how we do as we get to the 5,800 area, or more importantly, 6,000 and 6,100, because the market hasn't really proven that it can trade well into that zone. As we know, the first time testing 6,100 was early December. Yes, it hit one of our long-term targets at that point, but not much more after that. So that's, of course, something we'll have to keep an eye on over the next few weeks if in fact we do get back up to that area. So of course, we're always looking at the two-way volatility, and a part of that is tracking the number of 1% declines, because as we know, in the worst markets, not only do you have a lot of 1% moves overall that's dominated by 1% declines. Yes, that is completely obvious at this point, but tracking this on an ongoing basis can tell us when things are starting to change potentially. And so looking at the data and price action through Monday, May 5th, Cinco de Mayo, we know that that's when the S&P 500's 9-day winning streak ended. We had 10 straight days of no 1% losses. It's not a lot by historical standards, but 2 straight weeks of the 1% declines, that's the longest streak since 17 from January 28th to February 20th. And as we know, right after that is when things got extremely difficult. And so barely went 1 or 2 days without a 1% decline during that whole time. So see that change even after the lows shows us that, number one, there hasn't been a lot of aggressive short selling, hasn't been a lot of aggressive profit taking, whereas the market, of course, has caught a bid on the way up. And the best case scenario is for that type of action to simply continue. As we continue to see bullish patterns form, see the breakouts, so forth and so on. We know the recipe for success that we look at by now. But just for some perspective, let's remember 2024 saw various periods of low to high volatility, and arguably the most quiet or boring time was also the best uptrend from that May 1st right here. So we had that higher low after the low in April, which then continued all the way through July 16th, led to 52 straight trading days of no 1% decline. So needless to say, if that were to occur, if we had numerous months more of the 1% declines at this point, we don't have to go out on a limb to suggest that we'll be at new highs with the market probably substantially above the former highs. Now, again, that's a big if, but that is the type of scenario that, of course, we always look potentially to have if we're getting that next up leg. That will be the next phase, and we'll see how long that takes. Because remember, we've seen this before. We've shown this chart before, and when we had those volatility periods, this is the one we just talked about, right? You can tell this was May 1st, that last 1% decline. This was July 16th, 52 weeks later. What happened in between there? An uptrend with hardly a dip along the way. More volatility, finally subsided, another uptrend. And again, we thought the same thing looked like it was going to occur as the new year began, because we didn't see a lot of 1% moves. But as you can tell here, there were 3 or 4 1% declines along the way with no 1% gains. And eventually that led to, of course, the huge amount of volatility we've seen from that point now, which we're still trying to come back from with some very good buying near lows. So looking at 2025 versus 2024 in terms of the two-way volatility tables that we look at, we're coming off 2 straight months with 12 1% moves, which is a lot. A lot for 1 month, 2 in a row. It just tells us exactly what type of environment we've been dealing with, right? So last year, we always had 1 month with at least 10. That was August. It was over quickly. You remember, the other aspect to consider is that we already have 19 1% declines for the year, right? Through not just about 4 months in a few days, compared to 20 through all of 2024. Now, of course, if this pace continues, then we're going to see a lot more downtrending action. If the market's character completely changes from that point and it ends up being something like the second quarter of 2023, then of course we can continue to see uptrending action. So we can see how things change if we just look at all of the action from April through this past Monday, where again, a huge amount of volatility, both up and down, came. And this was April 7th. S&P was only down 20 basis points. So that was the huge reversal off the lows. And from that point, started to see still a lot of two-way volatility, but then the number of 1% gains started and eventually cleansed the system of the intense selling. And from the last number of days, as we know, 10 straight days without a 1% loss and many more 1% gains of losses. That's a recipe for at least a big turn. Now, I think it's important to compare April 25 to August 24, because as we recall, this is August, right? We had those 3 straight 1% declines to start the month, technology getting completely ripped apart, the turn, and then from that point through the end of the month, 7 1% gains. that then set the stage for the market then to turn higher, and we saw many months of uptrending action after that. Now that compares to April 2025. Once more, this was August 7th, right? Huge off the lows, rallied and finished relatively flat. And those 1% gains that we had last month all happened after the low. Now, we had to endure some back and forth movement along the way, but it's a similar setup. So if we then just think about the next few steps after that, what do you want to see? Something similar to what we saw in September, higher low, then off you went for a few more months. And that eventually could happen once more. And if it does, as we know, that will then lead us to new all-time highs once more. A few steps forward, but again, if we're looking at a blueprint of which to follow, we don't have to look too much further in the past because it just happened a number of months ago. So in terms of indicators, when we're watching closely, it's just the traditional Bollinger Bands. As we know, it looks at 2 standard deviations, both above and below a 20-day moving average, which is the dotted line in the middle here. And not surprisingly, on the way down, hugging the lower line, a little bit of a rally, and then when things really fell apart at the beginning of April, noticeably below it. So eventually, we need to see a snapback rally, which of course we did, and now that has now pulled the S&P right back to the upper band, right? No surprises. If you look back all the way to the October 2023 lows, all of the first time that the S&P tagged the upper Bollinger Band after being below it for at least a few weeks, this is what it looked like. So most of those lines are in red, which signifies that we at least had some sort of pullback over the near term. Some of those were substantial. This one nailed basically the March 2024 high. This one nailed the March 2025 high. This one nailed the July 2024 high as well at the top. And along the way, some other minor pullbacks. Now, there were a few times when the market was going higher. And of course, this occurred early in the comeback from late 2023 through 2024. It has led to more positive uptrending action, right? As we have here in blue. So it's going to be a good test at this point because we haven't really had a situation since the beginning of last summer in June where hitting the upper band has then led to additional upside action without any sort of pullback. And again, we're in a very tense situation. We know we're waiting at every headline at this point because we know how the market has moved on both sides of the tape over the last few weeks. So best case scenario, of course, if because of the confluence of resistance we just talked about, it wouldn't be surprised to see a pause. That's then a minor pause, which then sets the stage for even more bullish patterns, right? That would tell us then once more that the market's character has changed and maybe there is more upside ahead over the near term. If the opposite happens and we see much more of a pullback, then we know that volatility is still going to remain high. Obvious, but very important to remember as we go through this. Finally, let's look at patterns, of course. And so we talked about this a few weeks ago in our last video, how we're always looking for at least the beginning stages of the smallest bullish patterns to develop after the initial rally off of the low. So if you recall, a few of these here kind of failed, back and forth movement, very volatile at the beginning. But over the last few weeks, things have settled down just a bit to identify some higher lows here. And so the first iteration of one that has worked and we've seen a breakout from that point was this on a 60-minute chart with a target of 58.40. From there, if we zoom out a little bit, this is now the daily chart. We can tell that another much bigger pattern now has developed. This is a cup and handle pattern. And if this one holds, it would give us a target of 61.25, which would be right in line with the former highs. And if this formation looks familiar, it's because just about everything we look at looks similar to this in some regard, right? Because as we know, the snapback rally was destined to happen at some point. Did we think we were going to get 10, 20, 30% moves in select stocks on April 9th? No. And that even wasn't the important move. The important move is always the ensuing pullback. And a lot happened in those few days that followed. We got that higher low in most areas, then leveraged that, broke out from the high from early April, and now have continued higher over the last few weeks. Now, we know the movement has not been so substantial. So some people are poking holes in this advance, saying that it hasn't had the type of volume that we had at the lows when things are going insane and the moves are much more subdued. But isn't that what we want? Those are characteristics that we want to trust. Because if we had a ton of volume on the way up continuously, it would just show the emotion continues to be high. And from my perspective, less trustworthy. Now, a lot of this is going to be in regards to what we, of course, we hear in the news going forward, but more importantly, the reaction to that news. So we'll see if these patterns continue to hold, through the Fed's meeting and any other headlines in regards to tariffs over the near term. So that means we have two bullish patterns in motion and no bearish patterns have formed yet. And in fact, the last one that occurred was the bearish flag pattern. We got that downside break and almost immediately had that downside target hit again as things rolled over in April. And at the time, we said the good part was that there's no more bearish patterns in play. So at that point, it was a jump ball in terms of what side was going to take the reins next in terms of forming the next set of patterns we know at this point is the bullish pattern so far. So as we stand now, again, through action on Monday, May 5th, two live bullish patterns, target of 4% away and 9% away, with both of them sitting, around 2.5% above those breakout zones or around the same points in front of the Fed meeting. So in terms of gauging risk, risk appetite or speculation, we can look many areas. We talked about two-way volatility that we reference a lot. The VIX has been a very good one as well. But if you think about what ETF that we look at shows really when investors are excited about the prospects for technology, especially high growth speculative ones. Well, of course, that's the ARKK ETF. And so what it looks like now, it's obviously come back and been testing its declining 50-day moving average and obviously pretty substantially away from its high. So lagging the S&P in terms of that sense because it had gotten hit so hard on the way down. But it too is forming what? Bullish pattern, very similar, right? We just talked about that cup and handle pattern for the S&P 500. The same price points in the same time frame is pretty clear here on ARK where it had the breakout, maybe testing that breakout zone again as a 50-day moving average is right there. But as we can tell, if it does hold there, or even if it comes back down, there's still the chance that a more substantial bullish formation or foundation, can be built over the next few weeks to few months. And so we're not pounding the table on this, but understanding that these type of things are potentially in the works for many areas. And if they start to work for the most speculative ETF, arguably, then you would think that they're going to be working for other areas as well. So it's important to at least track this. Now, we know that ARK has outperformed and underperformed the S&P at times, so we're not losing this as an absolute guide. But if we see this starting to work, again, it will give us a good sign there's risk appetite elsewhere as well. So, right now, even though it's been frustrating over the last 2 years, it has maintained this upper sloping channel itself, where the S&P, right, is below this has had more spikes and many crashes along the way, but still maintained this upper sloping nature. So that's an important one to consider as well going forward. And let's forget, we've been teased before. We saw breakouts, as early as mid-2023, failing all around the 50-ish mark or so. Finally got that breakout in late 2024. It looked like it was really going to lead the comeback potentially. And of course, then fell off a cliff as many of its most influential and risky holdings really get hit hard over the last few weeks. And of course, now trying to get back above that 50 zone. So another view we're looking at is this. Again, just a huge bottom information potentially. It had that downward sloping channel, which it finally broke out of. Had a nice breakout, but now back down to it. So again, just shows how important this zone near 50 or just above it is for ARK to get back. So this is a performance chart going back to the beginning of 2023. And as we can tell with these vertical lines in blue, this shows the times when ARK really started to perform well. And when it did, it lined up with S&P doing well at the same time. Not a surprise, but indication of things. This recent pop off the lows in terms of performance for ARK is real. Then we can make the case that the S&P could follow suit. So now that we know the steps involved to eventually get back to a new uptrend, but let's not forget how things proceeded when the market rolled over just a few months ago. And to refresh your memory, check out this video next.